Welcome to Nasdaq TradeTalks. I'm Jill Malandrino, global markets reporter at Nasdaq, coming to you live from Consensus in Austin, Texas. Joining me for this segment, we have Kevin Corstorphine. He's DeFi Growth Lead at API3. We're here to discuss recovering lost value in decentralized finance. Kevin, it's great to have you with us. Welcome to TradeTalks.
Great to be here. Thanks for having me.
You got it. Let's get into this. What is OEV? Why it's a problem that needs to be addressed?
Right. So to understand OEV, it helps to start with MEV. So MEV is maximum extractable value, and this is the value that can be extracted by auctioning off the right to include or exclude or reorder transactions as they're put into a block and settled on the blockchain. This can allow for opportunities like arbitrage or front running or sandwiching,
yes.
Things that happen in traditional finance. And one of those kinds of MEV is prioritizing liquidations. And so liquidations are something that can be addressed at the Oracle level through Oracle extractable value. So instead of these third parties hosting auctions where they auction off the right to reorder these transactions, we're able to host auctions at the Oracle level where searchers bid for the right to prioritize liquidations along with the price feed update that catalyzes the liquidation.
Yeah, and I think let's actually step back a moment here because I just read about sandwiching myself a few weeks ago, and there was, the MIT story where, they were able to prove that front running is an issue. Explain to the audience what sandwiching is and why it's a challenge.
Yeah, so if you see a transaction or someone wants to make a buy, you can make a transaction before that. That would increase the price, and a transaction after that would
because
it
trades as blocks.
So it's basically when you see order flow, you can extract value from it. And a good parallel to traditional finance would be like Robinhood selling order flow to Citadel.
Right.
Citadel could see order flow. They got a lot of hot water. It happens all the time, but Robinhood got a lot of hot water for it. So this happens on the blockchain, and just due to the way that blockchains work, all order flow is visible. Or I shouldn't say all, but it pretty much is. For purposes of this, it is. And so it's kind of been something that has been democratized for the greater good. But the people benefiting from it still aren't the people that are having value extracted from them. It's these third parties that add nothing to the DeFi ecosystem,
right.
And there's just a better way to do it. And what we do is recapture that value and give it back to the people who it's extracted from.
Right.
And this is hundreds of millions of dollars over the last few years. It's
like I said,
trivial.
I've just been reading about it, and it really is quite substantial. And like institutional level kind of money is substantial.
Yes.
What are some of the main issues in the Oracle space? Is it largely related to that?
Well, that's certainly one, and I think it's kind of been something that has been addressed but still exists, and so people, I'm not sure if they see it as problematic as they should because there hasn't been a good way to recapture it for the people. So we certainly see it as a problem, and I think people will view it as a problem when they realize that if they aren't using API3, they're losing out on millions of dollars. So I think that'll be a problem. Other than that, though, the way we were founded, there's a difference between first-party oracles like we are and third-party oracles like some of our competitors. It's just a difference in architecture. And what a third-party oracle is there's a decentralized network of node operators, and then they go and source data from whoever. But the thing is, they can source it from a single data provider, and then say they're decentralizing, but it's not. It's just from one person. And there are economic and logistical issues with doing that. It's difficult to get unique data on chain. It's difficult to convince all these node operators that it's worth their time to go source that data and that they'll make money by doing so, and it's logistically difficult to coordinate them and do various things. So what we do is that instead of decentralizing the node operators, which I don't think makes an enormous amount of sense, we decentralize the data providers, and we get each one of our data providers runs their own node, and then we aggregate the data providers on chain. So it's end-to-end transparent. You know exactly where it's coming from, and it also allows us to do some better things economically.
It's so interesting. One of the key themes that's been emerging from Consensus is improving the user experience, right? Yes. And not, for the end user, not focusing so much on what's happening with the architecture, and leave that to the engineers, the developers, so that you can have a good user experience, right? And that seems to be what API 3 is also working on as well.
Yes.
Right.
I think in DeFi there's still a long way to go on improving the user experience.
Right.
But if you're in DeFi and you need to use an Oracle, we're as easy as it gets. Some of the other problems that people are facing are a lot of the newer oracles they're constructed in pull architecture, which is different than push, and we're push. And so to provide data in push form, they kind of have to bootstrap things in different ways. They might make a DApp run some infrastructure. They might make a DApp run centralized infrastructure, make a DApp pay for gas, or they're just all these ways that it wasn't purpose built for, but we are, and we're purpose built for it. All someone has to do is go to basically talk to me and we'll spin the feed up for you, but they could go to our marketplace and spin up the gas and we'll have a feed live in 10 minutes. And for this Oracle extractable value that I was talking about, the dApp doesn't have to do anything. They simply read our price feed, and that's it. We're about to go live with this, but it's 7 minutes of work for the largest DeFi dApps, and I get to say, hey, we can make you $50 million a year. It's incredibly easy, and yeah, it's part of the reason, I don't want to bury the lead here, but we went from $2 million in total value secured to $1 billion in 100 days.
Yeah.
And that's the metric that we judge everything by.
So what do you expect for API 3? What's next for it? Where do you see future growth?
I mean, well, we're certainly happy with getting to the billion milestone, but just seeing the way that, the way we were able to do that, it wasn't one big thing. We haven't even released Oracle extractable value yet. It was doing a lot of the little things right, and I think that's building in a way that people can trust. I mean, there's different philosophies in Oracle architecture as well.
Yeah.
Like, are we some Oracles put the burden of due diligence on a dApp saying, okay, we'll make this feed for you, but it's up to you to see if we did it right and if it's not going to rug pull you. We don't take that approach. We maintain the burden of due diligence, and anything you see on the API 3 market is crafted to be enterprise grade. And I think there are advantages in spinning up price feeds and kind of being on the newer edge of that, and I can see why that's good in some use cases, but I think for the direction we're going, I think it's better to be conservative in that, and we've never had a misreport ever, and that's something that...
Well, I think governance is really important too, especially if you want to continue, working with enterprises and the integration and so forth. It's not, us versus them sort of thing, but if you really want to integrate, I mean, governance is important, especially for, let's call it financial services. It's a heavily regulated industry. You can't get around that. So I think they're looking for that type of accountability.
Yeah, and I think, I don't want to say we're in like a great regulatory environment, but it seems like it's shifting a little bit, right, with the ETF, and certainly like the beginnings of going the right way, and I think it'll be a long time for it's complicated. It's not in the weeds on this,
right.
But at least the ship is starting to turn. And I've seen a lot of crypto go elsewhere. I'm from California and the Bay Area, and it used to be 90%, maybe not 90, but a lot. Now it's 10% in the United States, and so I think that's because of a hostile regulatory environment that hopefully we can get back. I mean, there's so much.
Well, certainly, the brain drain is glaring.
Yeah.
So you want to make sure that you don't want to stifle innovation, but you do want to have guardrails around it so you can operate.
Yeah. So hopefully that'll be a good tailwind.
Well, we'll see what the conversation looks like next year, won't we? Thank you so much for joining us on Trade Talks, and thanks for joining me from Consensus. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.